Welcome to CrushTheStreet.com's weekly market wrap-up. After several weeks of an illogical but seemingly endless bull market, we finally saw signs of weakness with losses felt across the board, especially for the Nasdaq. Even more significant was the S&P 500 index, which is still hanging on to the psychological 1500 mark, but has lost almost 2% off its high point from this past Tuesday session. Some of the declines were no doubt exacerbated by the recent Fed minutes, which indicated that a quicker than expected end to quantitative easing programs is on the table. The sudden hawkishness from the Federal Reserve puts the markets in a no-win situation. On the one hand, because the economy is improving from the perspective of the paper markets, the Fed may indeed pull out, and while pulling out is usually operated under a positive context, especially if you don't want to pay alimony, in this case, it highlights the fragility of the overall economy. Just a mere mention of no QE had a profound effect on the markets. What would happen if the Fed actually did seize their programs? And then, on the other hand, if the markets fail from here, QE will be back on the table. But the question would be, is it enough to stop the deflationary momentum before a mass panic occurs? For this reason and several others, precious metal investors continue to hold strong in their positions. Yes, at times it looks crazy, as if we're dumping money into an asset that continues to fall further and further down. Even the most hardened gold or silver bug has doubts sometimes. We all do. But consider this, right now the S&P 500 and spot gold share a near 1-to-1 ratio with each other, meaning that a Krugerrand would be able to buy one share of the index. One or the other is either overvalued or undervalued. Given the current economic context, I would propose to you that the equities are overvalued. Consider the work of Yale economist Robert Shiller, who states that the historical average for the market price-earnings ratio is 17.5 and that the current figure is 22.8. Over time, prices usually revert to the mean. Will there be continued pain in the bullion sector? Most likely we'll enter a choppy consolidation phase where all the weak hands in the market will effectively be flushed out. For silver in particular, many technical analysts will probably start working on a new thesis, although it could be argued that silver is trading in the lower range of a declining trend channel. I am most particularly interested in the US dollar index, which hit a near-term high of 81.46. While the momentum is certainly bullish for the paper pushers, it remains to be seen if it can break the 81.50 horizontal resistance line. On Friday, President Obama will meet with Japan's Prime Minister Shinzo Abe, who is looking for support of his nation's monetary loosening protocol. If the markets interpret a willingness by Obama to play along, we could see lower yen, higher dollar, and more pressure on the metals. Ultimately, however, more and more people are voicing concerns over the US economy, and this could give way to another fear trade opportunity. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.